Muted. Recording in progress.
Okay, can you hear me? You're on mute.
Going to be our lead today. So welcome to the City of Grand Prairie Basics of Lending, Business Lending. As you can see on the screen, Mr. Tim is here. We are trying to get his audio connected. So Mr. Coates, is your audio connected?
I think so, but I think there's gonna be background noise. Is that okay?
I can't hear you.
You still can't hear me?
And I'm gonna turn my camera off and let you have the floor. Thank you, Dean Fletcher, for that.
Awesome. So everybody can hear me? Is that too much?
Too much background noise?
So
My name is Tim Coates, and I'm the Director of Community Outreach and Small Business Lending.
I just
I
need
just need
somebody
to probably put in the chat if that the sound's okay.
Does it sound
Okay?
Are y'all able to hear me now? Okay,
So I'm gonna go ahead and get started.
So my name is Tim Coates,
and I'm the Director of Community Outreach and Small Business Lending for Prairie Bank.
And typically what I do is I help small business owners with being able to actually provide financial training programs actually for small business owners throughout all of Texas and Oklahoma. And do master classes throughout all of Texas and Oklahoma. Actually, that's one of the financial programs that I help with. I'm hearing a bunch of background noise, so I'm trying to figure out if you guys can hear. So we'll go ahead and get started. So the first thing I want to talk about is required documentation. Whenever you're going through a lender, whether it's going through Prosperity Bank, whether it's going through any other financial institution, alternative lender, we call them some of them are CDFIs, Community Development Financial Institutions. That would be like a Live Fund or a People Fund or a William and Jr. They're typically also going to be
asking
for these required documentation
when you're going to try to go to a lender for a loan.
So the first thing you see
there is the entity documents.
So you first need to have your entity
documents in order.
So if you're an LLC or corporation, we're going to be asking for your
certificate of formation.
If you're an LLC,
we're going to ask for also on top of the certificate of formation, your operating agreement.
That operating
agreement shows what the percentages are, who actually has ownership to sign on behalf of the entity for a loan or a line of credit or open an account as well. For a corporation, it would be your bylaws.
So bylaws will be showing
the same thing, basically what percentages.
Mr. Coates, one second. Let me see
Yeah.
that, because we have some questions in the chat that send us some feedback noise. So it may be the computer is on, one of them needs to be on mute. Maybe it's the computer on and the audio's, the phone is on, so one of them needs to be on mute.
Can they hear me now? Are they able to hear me?
They can hear you now. It says much better. Okay, Mr. Cole, now they're saying that you're muted. I can't hear you, so I'm not sure, but it says he's muted himself. He fixed for audio, but you
Yeah,
muted yourself.
you muted me. Can they hear me now?
I'm not sure.
Can somebody put it in the chat to see if they can hear? Because I just took them out.
So maybe
myself.
just hang up on the phone audio.
Yeah, I already did that. I just have a
Okay.
laptop. I just need somebody to put in the chat, hey, they can hear me.
Yes, can hear you now. Everyone's saying yes. Perfect.
Okay.
All right.
So
Let's
so
go.
it's just my laptop. They can actually hear me. It's kind of strange that it doesn't work on your end, but it is what it is. It's technology. All right. So the required documentation. I don't know what part they did not hear, but I'll just go ahead, kind of go back to the start. Required documentation. This is really kind of the first thing that we look at whenever you're trying to get a loan or line of credit request, whether you're going through Prosperity Bank or you're going through any other financial institution. That includes alternative lenders like the CDFIs, Community Development Financial Institutions, like your Live Funds, People Funds, or William N. Jr. There are several CDFIs, but they're going to be asking for this documentation also. So typically you see the first bullet point, that first documentation that we're going to ask for is your entity documents. This is your identity of who you are, what your business is. And then also with going with those entity documents, let's say you're a LLC or a corporation. Since we're in the state of Texas, we're going to be asking for a certificate of formation, and that's usually filed with the Secretary of State of Texas. So that certificate of formation will show, if you're an LLC, it'll show who the managers are, who the members are. If you're a corporation, it'll show who the owners actually are too as well. If you have an LLC, we're also going to ask for, on top of the certificate of formation, your operating agreement. That operating agreement will actually tell us what the percentages are of ownership. Maybe if you have multiple owners and they have different percentages of ownership, it's going to show that. It'll be bylaws for a corporation. It's going to show that the percentage of ownership actually for that corporation. So the reason why that's important, because it shows us who actually has the authority to sign on behalf of the entity for a loan or line of credit request. Typically, depending on the lender, but typically most lenders, if you have 20% or more ownership, you're going to have to be on, that person will have to be on the loan or line of credit request. If you're a sole proprietor, we're typically going to be asking for your assumed name certificate that you file with the county. If for those LLCs and for the LLC and the corporation, we're also going to be looking for your letter of confirmation from the IRS that shows your federal EIN number, because that's what we're going to be using, or that's what you're going to be using to actually apply for a loan. Sometimes sole proprietorships have separate EIN numbers, or you could just use your social. That would actually be that person's EIN number if that's what you're using for a sole proprietor. So those are entity documents. It's really important because that's your identity of the business, and everything really needs to match. So whatever you have that's filed with the IRS also needs to be filed. The name, example, the name should be the same as filed with the Secretary of State. Also, that's filed with the IRS too as well, with your federal EIN number. So you see, the next bullet point is business plan with financial projections. So if you're a startup business, you're always going to have provide a business plan with your financial projections and assumptions. And I'll get a little bit of detail actually on that because there's a lot that goes into a business plan, but we're going to want to see a lot of things in that business plan Business plan is going to be, typically we're going to want to see, obviously what you're trying to do, what type of business that you're trying to start or run, who's going to be involved, all parties who are going to be involved, what are they going to be their job actually, and what they're providing actually to start this business, and do they have the experience too as well, and what experience do they have in actually starting this business or running this business. With the financial projections, we're going to want to see typically 36 months of projections in 12-month increments. So along with the assumptions, so it would be, hey, my revenues after 12 months, my revenues will be, X, my expenses will be Y, and then my net income will be Z. I'm simplifying it, but that's kind of what we're going to want to see. And your assumptions are where you're getting those numbers from. Well, based on the industry average in this area, in my market, my revenue should be X, right? My expenses should be Y, and my net income should be Z. Again, I'm simplifying it, but just kind of breaking that down for you guys. In the business plan, we're also going to want to see your, what you're asking for, what your total project cost is what we call your source and uses of funds. So, hey, I'm looking to purchase, I need $200,000 to be able to purchase, equipment, inventory, and I need to be able to hire people too as well. And I need money for build out because I'm trying to get into this space so I can be moving ready to operate my business. And we're going to want to see it broken down too as well. So, hey, I need $50,000 for inventory. I need $50,000 for payroll. I need $50,000 for build out. And I need another $50,000 for equipment. That's that total. The total of that would be $200,000. And then we're going to want to see, what's your skin in the game, if you will, what's your capital injection or cash injection or down payment. It's the same, it means the same thing, but a lot of times we use different terminology. So it's down payment. How much are you putting down to be able to get that inventory, to get that, to help with the build out, to operating your business for the equipment, and also payroll. How much are you putting into that? So typically we're going to want to see where we start the conversation is 20%. So in that example, $200,000 total project cost, you say, hey, I'm planning on putting down $40,000. So then, bank or financial institution, I need $160,000 loan from you so that I can do all this. That's what we're looking for in the business plan. There's other things too as well, but that's pretty much it in the nutshell. Also, we're going to be looking at from a capacity standpoint, your current business financial statements, so your profit and loss statement and balance sheet. Since we're in May now, as of right now, we would be looking for your current year-to-date profit and loss statement and balance sheet. So it'd be from January 2023 to the end of April 2023, right? On the profit and loss statement and balance sheet. Or the next bullet point too as well, we'll be looking at 2 to 3 years of business financial statements, 2 to 3 years of profit and loss statements and balance sheet, 2 to 3 years of business tax returns. And typically, I know with me, every lender is a little different. If I have 2 to 3 years of business tax returns, I don't necessarily need 2 to 3 years of profit and loss statement because I got it on your tax returns. Unless I don't have a balance sheet, then I'll ask for a balance sheet too as well for the last 2 to 3 years. So you may say, well, I'm a startup business. I don't have the past 2 to 3 years of business tax returns. I don't have the past 2 to 3 years of profit and loss statement and balance sheet. I just started my business. So obviously we're not going to ask for that. But let's say you started your business this year and you've been in business for 4 months, if you will. So we would ask for your current year-to-date profit and loss statement. We would definitely ask for a business plan too as well. And on top of that, we would ask for the past 2 to 3 years of personal tax returns, because you should have filed your personal tax returns, right? And I say past 2 to 3 years because it depends on the lender. Some lenders only want the last 2 years, some want the last 3 years. So every lender is different as far as on what they ask for on that. But that's why I say past 2 to 3 years, because it really depends on the lender what they're asking. So I'm going to skip that next one that's right there. the current personal financial statement, because I'll lump it into the third bullet point. But you also see the current aging accounts receivable schedule. So this is if you have clients that pay you on terms. So if you have clients that pay you, I don't know, every 30 days, 60 days, 90 days, 120 days, whatever, they're paying you on terms, you should have an accounts receivable schedule. And typically, we like to see, if you've been in business for, let's say a couple of years or whatever, we're going to want to see that accounts receivable schedule because we may be able to use that as collateral for a line of credit. That's why we ask for that. Now, if you have clients like for your product and service that you're providing, your clients pay you immediately. As soon as you provide that product or service, you're not going to have an aging accounts receivable because they're actually paying you right there on the spot whenever you're providing that product or service. So we're not going to ask for that from a documentation standpoint because you're not going to have it. The reason why that accounts receivable is important, we may be able to use that, like I said, if it's good accounts receivable, we may be able to use that for collateral for a line of credit or a loan request. And I'll get into that a little bit later as far as on what the definition of good accounts receivable would be, or challenge accounts receivable. So you can see on the third bullet point, completed business loan application, current personal financial statement. I'm gonna lump that in. These are usually templates and documents that we provide as the lenders or as the financial institutions. It's on our own template that we're providing to you guys. Sometimes people have their own personal financial statement that they already done, which is fine as long as it's up to date. We typically use that, but a lot of times we like it on our own template because there's different things that a lot of times are on our template that may not be on the one that you're providing. But that's really important because this is your initial look to the lender with that current personal financial statement and completed business loan application. I would say it's a high percentage of small business owners, not just through Prosperity Bank, but really across the board to any lender. It is a very high percentage of small business owners when they're trying to complete their business loan application, their personal financial statement, they do not complete it. It's not completed and it's not accurate a lot of the time. So this is your initial look to the lender, and it's not a good look if you're not completing it all the way through and completing it accurately. This is where you have to have a mentor or you have that good relationship with your banker, right, with your lender, so you can ask questions if you don't understand what is being said on the application or what is being asked on the application and what is being asked on the personal financial statement. They can't fill it out for you. However, they could at least answer any questions that they have regarding some of the questions that are on there. But again, this is where you should have like a mentor or you have that tax advisor or CPA that can help you be able to fill these things out completely and accurately. This is very, very important. So the next three bullet points are really just, for specific requests, specific loan requests. So if you're actually purchasing a commercial building or investment properties that you're actually trying to, let's say you're a real estate investor, you're trying to invest in investment properties or rental properties, our structure starts with that purchase agreement. That's really our first, that's where the structure actually starts. So it'll have the purchase price. Typically we'll have who the buyer is, it'll have who the seller is, it'll have where the address of the real estate that you're looking to purchase. That's really important because, again, that's going to be used as collateral. So, and we're going to do an appraisal on that. But that's where that's where our structure starts. So that's why it's really important on top of the other items that we're asking. The lease agreement for leasing a property. So if you're just trying to lease a space, again, that's where our structure starts. Obviously with the lease agreement, something that's really important about that is the term of the lease too as well. So let's say, for instance, you have a 5-year term on your, for your space that you're trying to lease and you're trying to get a loan. It's really important on SBA loans, I can just tell you, because usually we want the loan term to be able to match the lease terms. I can tell you on SBA loans. So let's say, for instance, you're trying to get a loan for startup cost, if you will. And so typically we're going to be looking at, again, that lease agreement. Obviously, that's where all your equipment, that's where you're going to be operating out of. So obviously the address is very, very important too as well. But let's say that lease agreement is 5 years with no option to renew. typically we're not going to go out farther than 5-year term on that SBA loan. On another example, let's say you have lease terms of 5 years with an option to renew for 5 years. So we may be able to look at doing the term on that loan, like SBA loan, if you will, for 10 years, right? Because you have a 5-year term, but you also have an option to renew for 5 years. So that total would be 10 years, as long as the lender's okay with it. Again, we won't go out. We don't want to really go out farther than 10 years, holding everything else constant. Bill of sale or invoice for equipment purchase on that last bullet point. So this is if you're purchasing equipment. The bill of sale, again, this is where our structure starts, and you want to make sure everything's included in it, taxes, everything on that invoice. So again, that's where our structure starts. So we would need the bill of sale or invoice for the equipment purchase on top of, like I said, all the other documents that we're asking for. And there'll be probably additional documents depending on the strength of depending on the structure of your deal, depending on the strength of your deal, depending on the, maybe the weakness of the deal too as well. But these are kind of the general items that you would need, documentation that you would need when you're trying to apply for a loan or line of credit request. Oops, sorry, skip sides. So you can see that next slide, the next slide there. Why does a bank need my financial information? Well, we need to determine the analysis of the health of your business. To determine if your business can support your lending request that you're asking for, according to how the lender is looking at it. And this is where I'll get into a little bit of ratios. So you guys probably understand debt to income ratio when you're trying to buy a house, buy a car, get a personal loan or credit card. You probably know, you typically want your debt to income ratio to be as low as possible. And we look at debt to income ratio too as well. We look at a lot of different ratios, but the really important ratio that we look at to determine if you have the capacity to be able to pay us back is what we call debt service coverage ratio. And this is something you might want to write down and take notes, because this is really important. The debt service coverage ratio. What that ratio is, it's your annual net income divided by your annual debt. I'll repeat that because I'm sure you guys are writing it down. What that ratio is, it's your annual net income divided by your annual debt. And there's a certain number that we're looking for in that ratio. Every lender is different. You may have some lenders that are looking at 1.25 or higher. You may have some lenders that are looking at 1.3 or higher. You may have some lenders that are looking at 1.5 or higher, but the higher that number, the better. So just kind of keep that in the file cabinet, because when we go through the 5 C's of credit, we'll go a little bit more in detail about that. And I'll give you a specific example, specific examples to go through, what will make sense. So it also allows us to be able to, why does the bank need my financial information? It allows us to be able to know what type of debt you need. I'll get in that a little bit more detail too as well, but whether it be a line of credit or a loan, that's kind of what we're talking about, what type of debt you need. Typically, if it's short-term financing or if it's a short-term need, short-term definition being 12 months or less, the repayment period is going to be more on the line of credit as far as the type of debt. If it's longer than 12 months, as far as a repayment period, looking at more of a loan, term loan request. Also, always have a specific purpose for your loan fund. So, if you're looking to purchase a commercial building, the specific purpose is to purchase a commercial building, right? And let's say, go in a little bit more detail, specifically purchasing that commercial building to occupy your business out of, to operate out of, so that's the specific purpose. If you're looking to purchase equipment, purchasing the equipment is that specific purpose. Sorry, my light's actually on a timer. Anyway, purchasing that equipment is actually for that specific purpose, right? That's the specific purpose, that you're purchasing equipment so that you can help generate revenue to operate your business. If you're purchasing a business vehicle, you're purchasing a business vehicle to help operate your, generate revenue to bring in business. The one that's a little more complex, you have to explain a little bit more for working capital. I need money for working capital. we need to know specifically, what are you using that money for? Well, I need money for working capital because I got to be able to hire people for payroll. Well, I need money for working capital for inventory. I need money for working capital for payroll and inventory, right? You just got to be specific as far as on your request when you're asking for a line of credit or a loan. Again, why does my personal financial information matter? Or your ability to support the business if needed. I know we talked about, when I was talking about debt service, that was business debt service. We also look at your personal debt service too as well. And so your ability to currently support your personal living expenses and debt service, you kind of see right there in that second bullet point. So again, we're looking kind of at the same ratio. It's your annual net income divided by your annual debt. And we typically want to see your personal debt service either at, depending on the lender, 1.25 or higher, 1.3 or higher, or 1.5 or higher. Again, the higher that number, the better. So when we'll take the business debt service and calculate that from your financial statements, tax returns, all those things. And then we'll take your personal debt service and we'll calculate that again from your tax returns, any W-2 income or any other personal income that you're receiving, paycheck stubs and all those kind of things. And then obviously from your credit, we're getting your, what we call minimum monthly payments and times that by 12. That's your annual debt. And so again, we want that to be at 1.25 or higher, 1.3 or higher, or 1.5 or higher. But then we put so we take the business debt service, add your personal debt service, and that's what we call your global debt service. And again, we want that to be at 1.25 or higher, 1.3 or higher, or 1.5 or higher, depending on the lender. And also why we need your personal financial information matters, because we need to know how you've handled your personal finances. And we're talking about specifically your personal credit, right? If you have very challenged credit, you have collection items, slow pays, charge-offs currently, you have shown the financial institutions, the lenders, that you don't understand how to handle debt, or it's not that, or it appears that it's not that important to be able to handle debt. And so, we want to when we're actually providing loans or lines of credit, we want to make sure we get paid back and pay back on time. And we don't want to be on that list of not getting paid back and not getting paid back on time. That's why your personal credit really, really matters. It's really, really big. Or whomever's going to be on the loan, their personal credit, it really, really matters a lot. So now we're into the 5 C's of credit. And I like to talk about the 5 C's of credit because it really gets you into the mind of a lender and how a lender is thinking. And it really allows you to be able to understand what a complete loan package looks like when you're going to that lender for a loan or line of credit request. All these C's are actually popping into their head as soon as you come to the lender. Let's say you're asking for, I don't know, a $500,000 loan. The lender is thinking, well, what do they need the money for, right? That's kind of the first thought. But these 5 C's too are popping in their head very quickly, probably within seconds, you asking for a loan or a line of credit. So, and I'll try to go through each one of these C's. They're all very, very important, but I'll try to go through each one of them and explain, give you definitions, explain the details of each one of them, and give you specific examples of them. So hopefully they make a little bit more sense actually to you. So capital, how much am I putting into the total project cost? And I kind of explained it a little bit earlier. So capital injection, cash injection, down payment, it's all pretty much the same thing. So how much are you putting down? If you want to just kind of put it in layman terms, if you will, how much am I putting down for this total project? So let's say, for instance, you're purchasing a commercial building, and the purchase price of that commercial building that you're purchasing is $500,000, and you're purchasing this commercial building for what we call owner-occupied commercial real estate, meaning that you're going to occupy 51% or more of the space that you're going to be operating your business out of. So, and that's important too as well, because usually the terms are a little different on owner-occupied commercial real estate versus what we call investment real estate. The terms are a little bit different, typically owner-occupied commercial real estate is a little bit more favorable. So usually when you're purchasing owner-occupied commercial real estate, we're going to be asking for we're going to start our conversation asking for 20% cash injection, down payment, or capital injection, same thing. So in that example, if you're putting 20% down on a $500,000 purchase price of the commercial building, you have to put down $100,000, right? Which would mean then our loan amount to make sure that you can purchase this commercial building would be at $400,000. Now you may say to yourself at that time, the small business owner may say, man, I don't have $100,000. I got 50,000, but I don't have 100,000. Don't discount that. It still may be a deal that we can do just looking at a capital injection standpoint. We just may have to structure it differently. So it may be where, the $500,000 purchase price, again, we would come in at a $400,000 loan. Then we may have to get a secondary lender that's willing to be in secondary lien position, like a CDFI, like a LIFT fund or a People Fund or a William N. Jr. or Texas Mezzanine Fund that's willing to be in second lien position. And then maybe they come in at $50,000, right? So now we're at $450,000. And then you bring down your 10% at $50,000, which would be $50,000. So now we got $400,000 that's provided by, we'll just call it ABC Bank. We got $50,000 that's provided by the CDFI, the alternative lender, and we got $50,000 that you're coming down with. That's our $500,000, which allows us to be able to, which allows you to be able to purchase that commercial building to occupy and operate your business out of. We may be able to do that deal again, just looking at the capital injection. So you probably remember like 80-20 loans on mortgages, very similar to that. And it doesn't necessarily have to be at those percentages like the 10-10. You bring down 10%, the alternative lender is 10%, and we will typically be at 80%. That's typically where we're going to be max on owner-occupied commercial real estate. But the other percentages, like how much you're bringing down and how much the secondary lender is actually kicking in, that may be different. It may be 15 they're doing and you're doing 5, or vice versa. But I just want to make sure that you guys know that you may have, just because you don't have the 20%, there still may be a deal that can be done. So collateral is the second bullet point. This is important. We talked a little bit about this a little bit, but what am I using to secure this debt? In that example, the collateral would be the commercial building. This is really important because for a lot of different things. It minimizes our risk as the lender, and all these C's minimize our risk. But it minimizes our risk because if you were to go if that business goes out of business, how's the lender going to get paid back, right? So if you go out of business in that sense, if that business goes out of business, we would have a lien on the commercial building. We would take the commercial building, sell it, pay ourselves back. That's a big reason why collateral is important. Very, very important. And some acceptable forms of collateral, I think I said a little bit earlier, but we like tangible collateral, stuff we can see, touch, and feel, like a commercial building, like a business vehicle, like equipment. We also like liquid collateral, like savings accounts, CDs, stocks, some stocks, especially right now, some stocks. But we'll also look at accounts receivable, if it's good accounts receivable. And this is where I'll explain this. So, and I'll give you, I guess, 3 different scenarios. 2 scenarios where it's challenged accounts receivable and we wouldn't be able to use it as collateral for a line of credit. And then 1 scenario that we would be able to, use that accounts receivable as collateral. So the first one, I'll say this is challenged accounts receivable. Let's say you have clients that are supposed to be paying you on terms. Let's say they're supposed to be paying you every 60 days, but they're either not paying you or not paying you at all, or they're paying you very, very late. So they're paying you every 180 days instead of 60 days that you have. That's probably not a good piece of collateral for us to use for a line of credit because they're not paying you or they're not paying you on time. So I think that one's pretty obvious. Another challenge accounts receivable, let's say, for instance, you have 10 clients that are paying you on terms, and let's say assume that they're all paying you on time. But you have one of those clients of the 10 that makes up 90% of the total revenue of that of the accounts receivable. That may not be a good piece of collateral either, because if you lose that one client, you may have just gone out of business, right? So good, I would say good accounts receivable, one that we could actually use as collateral. Let's say let's use those same 10 clients. And assuming that they're all making their payments on time, that they're paying you according to your terms. And let's say each one of those 10 clients makes up 10% of the total revenue. That may be accounts receivable that we can use for a line of credit, right? Or a loan request, because you lose one or two clients, you still have 80 to 90% of your revenue that's being generated. That's probably going to be a good piece of collateral for us to use. We're not going to give you all 100% loan to value actually as part of the accounts receivable, the total accounts receivable, total revenue from the accounts receivable. We typically probably going to be looking at maybe 60 to 65% anyway, just to be sure. So that, again, that may be a good piece of collateral for us to use. So third C, conditions. This one's very, very general, but it could be the conditions are the rate of your loan or line of credit request, the terms of the loan, line of credit request, the fees associated with the loan or line of credit request, the structure of the loan or line of credit request, and the economic environment. This is all can be the industry that you're in, the timing of your request. There's a lot that actually goes into conditions of the loan, but that matters. And I'll give you kind of some examples actually on that. Let's say, for instance, we're in the pandemic, 2020, and your business, you have to be able to see people in order to be able to generate revenue to make money, right? And due to the mandate, you're shut down for 3 months, but you still had expenses because you're trying to actually keep your people on board, paying payroll. You're trying to keep your space because you're having to pay your lease payment, but you're not be able to generate enough revenue in order to be able to sustain, if you will. So then you come to a lender at that time, right? And you ask for a loan, but you can't show that you have the capacity to be able to pay the lender back currently. Timing of the request is just not the right time, for a regular loan request. So probably wouldn't be a good time to actually do that. And unfortunately, we probably wouldn't be able to move forward with entertaining that loan or line of credit request because you can't show you can pay us back currently. Again, that's conditions. That's why the PPP loans were, those disaster loans were actually created, right? The PPP loans, the economic injury disaster loan, it was for disaster situations to be able to help you kind of get back on your feet if you were one of those businesses going through that, that was going through that challenging time, for that business. Also, it could be the industry that you're in. So it may not be anything wrong with your loan package, maybe just for that lender. Let's say, for example, you are in the hotel industry and the lender actually the previous year took a $50 million loss from the hotel industry. Probably not the right fit for your type of loan, the industry that you're in, the loan request that you're trying to do. And that's okay. You just need to kind of know that up front. So, and be able to ask that lender, be like, hey, do you have any other recommendations? And typically a lender will say, yeah, I've got a friend over here, or I've got a couple of different referral sources over here. They may be willing to entertain your deal, based on what I see, if you're okay with me actually having a conversation with them. So again, it could just be the industry that you're in. It could be the time of your request. It could be the rate and term. Maybe some lenders won't go out. Let's say you're purchasing that commercial building, they won't go out farther than 20-year amortization, and their rate's at 9%, right? That you're trying to do to purchase this commercial building. But since they won't go out farther than, in order for you to show that you have the capacity to be able to pay them back, they really have to be able to go out 25-year amortization at an interest rate of 8.5%. But they're unfortunately, their policy and procedures won't allow them to do that. Just not the right fit, right? That's the conditions of the loan or line of credit request. But let's say we got XYZ Bank as another option. They're willing to go out 25 years at 8%, right? And you can show that you're cash flowing. Well, obviously you need to go through XYZ Bank. So it's good to have different options. Sometimes it's just not the right fit for the lender, just based on the conditions, just the conditions of the loan. So that's the third C. Fourth C, character. How have I handled other debt. So this is your personal credit that we're talking about. Again, I already kind of explained, hey, if you have very challenged credit, right, you have collection items, slow pays, and charge-offs currently, you have shown that you don't understand how to handle debt. And we don't want to be on that list of not getting paid back and not getting paid back on time. On the opposite side, the positive side, let's say you have a long, good history of making your payments on time. You have good balance to limit ratios with your revolving lines of credit. You have shown that you understand how to handle debt, you know? And when we're looking at a business loan, you know, if you're paying your personal debts actually that way, that's how we're going to look at it. You're probably going to be paying us back, right, on the business side. So it's not the only factor, but it's a strength to your deal. So when we're doing our write-ups, if you will, to the loan committee or loan approvers, that's going to be a strength that's going to be mentioned to your deal. Again, it's not the only factor because the other C's have to, you know, kind of be in line too as well. So fifth C, capacity. Do have the capacity to be able to afford this debt. This is debt service coverage ratio, what we talked about earlier. I feel that out of all the C's, this is the most important C. Because if you can't show that you can pay us back, we're just not going to do the deal according to the debt, you know, according to how the lenders are looking at it. So again, debt service coverage ratio is your annual net income divided by your annual debt. Now I'm gonna give you an example. Let's say, for instance, for this financial institution, 1.3 or higher is an acceptable cash flow or an acceptable debt service, showing that you have the capacity to be able to pay this financial institution back. So I want you guys to write this down. Let's say this business that's trying to get a loan, their annual net income is $13,000. And we're getting that from the tax return, the net income that's shown on the tax returns and your profit and loss statements. So if you have net income, if you're looking at a tax return, you're writing off everything, showing negative net income or zero as net income, it's going to be very challenging for you to get a loan or a line of credit because you can't show you have capacity to pay us back, right? But in this example, let's say the annual net income is $13,000. Let's say the annual debt, and the annual debt are the minimum monthly payments times 12 that the business currently has, and also the new loan or line of credit that you're trying to take on, right? The monthly payments times 12, and it's times 12 because annual debt. So let's say, for instance, that is $10,000 in this example. So you put that in your ratio, your annual net income is $13,000. Your annual debt is $10,000. Somebody does the math, you should get 1.3. So when we're just looking at this 1 year, this is an acceptable debt service or acceptable cash flow, showing that you have the capacity to be able to pay us back. What that ratio, according to this financial institution that we're using, what that ratio is stating is for every $1.30 of net income you have a dollar of debt. There's a cushion there. If something were to happen in an extenuating circumstance, pandemic, Texas snowstorm, you probably can still afford to pay us back. Now I'm gonna give you another example. So let's say now in this example, let's say your annual net income is 10,000. And let's say we just keep your annual debt at 10,000. I think all of us know 10,000 divided by 10,000 is 1. That's what we call your cash flow is tight, right? If you have something happen, an extenuating circumstance that happens, you can't afford to pay us back because you're really just making it right now. In other words, for every dollar of net income you have a dollar of debt. There is not a cushion there. So just looking at that 1 year, we're not going to do that deal. We would probably say, hey, your line of credit or loan request, you need to ask for a lower amount so your minimum monthly payments can be lower, so your annual debt can be lower, so we can get you a line at 1.3 or higher. Or we may say, hey, you got to put more money down because you got to get the loan amount or line of credit amount down, right? To get the minimum monthly payment down, to get your annual debt down, so that we can get it down to, so we can get it up to 1.3, your debt service coverage ratio. So this is why the relationship with your banker or your lender is very important. So you guys can work together to try to make it work, you know, for you from a capacity standpoint. But as a financial institution, as the bank or alternative institutions, if you remember from the required documentation, this is why we look back. So we look back, let's say you've been in business for 5 years. So we would look at, let's say we're asking for 3 years business and personal tax returns and personal financial statement. We would look back 2020 business and personal tax returns, 2021 business and personal tax returns, 2022 business and personal tax returns. And then for 23, we would ask for a current year-to-date profit and loss statement and balance sheet. And we do those calculations for each year. So each one of those years, we want you to be at 1.3 or higher. You know, according to the, we'll just use this financial institution as an example, 1.3 or higher for 2020, 1.3 or higher for 2021, 1.3 or higher for 2022, and 1.3 or higher for 2023. So hopefully that makes sense to everybody. Now, you can have a year, and I'll give an example. Let's say you, because of the pandemic, for this example, let's say you're at 1. Pandemic affected you, right? Which is causing you not to cash flow. But the other years you're okay. So let's say in 2020, you're at 1. 2022, 2021, your debt service was at 1.3. So you recover. 2022, your debt service was at 1.35, and 2023, it's at 1.4, even higher. That still may be a deal that we could do. We just got to explain to the loan approvers, and you need to explain to your lender so he or she can explain to the loan approvers what specifically happened in 2020 that caused them not to be able to cash flow and show they had the capacity to pay us back. Instead of saying, well, the pandemic just happened. We need more specifics. How did the pandemic specifically affect you? You may have an explanation, something like this. Hey, during the, I'm a business that actually has to be able to see people to generate revenue, right, at full capacity. And during the pandemic, we were shut down for 3 months. So I wasn't seeing a whole lot of people. I mean, we were still kind of making it work, right? Actually being able to pay some of our people. I still had payroll, I still had expenses. I still had, my lease space that I was having to rent out and lease out and have those expenses. Yet when we didn't fully recover at the very end of the year, but you can see that we started to have our capacity started to increase. So at the end of the year, our cash flow was at 1. So we're at least able to pay our debts and pay our bills. And you can see in 2021, we're at full capacity for the full year, we're at 1.3, so we're cash flowing. And in 2022, we're at 1.35 for our debt service coverage ratio. And 2023, we're even stronger now. That's how you would want to try to explain it, right, to your lender, so your lender can actually explain it to the loan approvers. It's a lot more detailed regarding that, instead of just saying, well, the pandemic affected me. So that's really, really important. The next slide, you see there, business line of credit versus business term loan. So I'll kind of run through this pretty quickly for the second time. Line of credit is typically for short-term needs. Again, like I said before, under 1 year or under 12 months. Repayment period is typically going to be under 12 months. It's reusable as soon as it is paid. This is what we call you use it, and you use it, pay it off, use it, pay it off. It's what we call rinse and repeat. And typically you have repayment, your repayment options are interest only. You may have some lenders that have your minimum monthly payment may be a little bit of principal and most of it interest, but a lot of times they'll have interest only option, repayment options. So you may use a line of credit. Again, let's say you're in a construction business. I'll give you an example. You're in the construction business, and let's say you got this contract that you just got. In order to be able to service the contract, you have to purchase supplies and materials up front, and you got to be able to pay your people to service the contract. Let's say the contract's a 90-day contract, and after the 90 days, you're going to get paid $60,000. That's how much you're going to make. Let's say the supplies and materials and paying your people that you have to do up front is going to cost you $40,000. And let's say you already have a line of credit, right? Let's say that line of credit, the limit is $60,000. So in that example, you only need to use $40,000, right? Because that's how much your supplies and materials and your payroll costs are. So use $40,000, get your supplies and materials, pay your people to be able to service the contract. You service the contract, contract's up, you complete it, After the 90 days, you get $60,000 payment. So you would take you would take part of that 60,000, let's say 20,000, and I would hope you would do this with it. Take $20,000 of the 60,000, put it in a business savings account, let it gain a little interest, and then take the 40,000, right, and pay your line of credit back. And now it's paid back completely. And now you got the whole 60,000 available to you again. You can go and get that other contract and keep moving. That's how you're supposed to use a line of credit. So term loan is really just kind of what it is. It's typically for a specific use, like if you're purchasing a business vehicle, if you're purchasing a commercial building, if you're, purchasing equipment, that's usually a specific use. Usually the repayment period is fixed. So maybe fixed for 5 years, fixed for 10 years, whatever. And usually the interest rate is fixed too as well. Let's say you have an interest rate, you're purchasing equipment at, 9%, the rate is fixed. It's not fluctuating. Sorry, I went a little bit too fast. Frequently asked questions, do I need a business plan? Well, I would say if you're a startup business, you always need a business plan. I would say even if you're an existing business, you always need a business plan for yourself, because that business plan is for you, right? To give you that roadmap of where you need to go and where your employees or contract workers, whatever you're trying to actually teach everybody, hey, this is what I see from my business. This is where I see my business going. This is where we want to go. That way everybody's on the same page. Regarding lending, if you're a startup business, you always need a business plan. If you're an existing business, typically if you've been in business for, I'd say probably at least 3 or 4 years, and you're not going to be adding an additional product or service to your business, we're probably not going to ask for a business plan. On the bank side, CDFIs, a lot of times alternative lenders, they're going to ask for it regardless. But yeah, that's typically, I would say if you've been in business for a while, over 3 or 4 years, I'm probably not going to ask for that if you're not going to ask for or add an additional product or service, to your business. Now, if you're adding an additional product or service to your business, we're going to want to see the business plan. We're also going to want to see the financial projections. How is that going to affect your revenue, right? How is that going to affect your expenses? How is that going to affect your net income? Why is it hard to get a loan for startup businesses, right? Well, you haven't shown that you have the capacity to be able to pay us back, right? Because you're just starting your business. The only thing that you have are projections. Projections are projections. Nobody really knows what's going to happen in the future, right? And so it's very, very hard for startup businesses to actually get a loan because of that. You can't show that you have the capacity to be able to pay us back. Like I said, we look back at your financials, tax returns and financial statements, and you're obviously not going to have those if you're a startup business, you're just starting. But you do need to have, this is why if you're starting a business or you're a startup business, you have to have an alternative source of income, i.e. full-time job, part-time job, another business bringing in income. Let's say you got a partner who has a full-time job, part-time job, or businesses that's bringing in alternative sources of income is what we call it. You got to have that to be able to show from a global standpoint that you have the capacity to be able to pay us back from the debt service coverage ratio standpoint. We will look at financial projections and take that in consideration, but that's not the only thing we use. We can't just use financial projections because, I asked you guys a question. What if we use financial projections? What if you're in the industry where you had to see people, and in 2019, you just started this business, and then you're using all these financial projections for 2020, right? Those projections probably were totally incorrect because nobody saw the pandemic that was going to happen. Nobody saw the snowstorm that was going to happen, in those next couple of years. Those are things that nobody really saw. We didn't know that was going to happen, right? So that's why we can't just go by projections. It's also hard for startups because there's no, usually when you're starting your business, it's all expenses because you're trying to buy the things that you need to operate your business. So a lot of times you don't have a whole lot of collateral either. So not only can you not show that you have the capacity to pay us back, there's nothing really for us to fall back on, if you will. There's no collateral, right? So if you go out of business, there's nothing there. Also, a lot of startup businesses go out of business in the first couple of years. It's a big percentage. I don't know the exact percentage, but it's a big percentage. So it's very risky. Remember, I told you we're always trying to minimize our risk. why do I need to personally guarantee? Well, first of all, I think you need to understand what personally guaranteeing means. Personally guaranteeing actually means that, you know, if your business goes out of business, you got a loan with any lender, and your business goes out of business, you're saying I'm personally on the hook to make sure that you get paid back, lender, on time. You get paid back fully, and you get paid back on time. That's what you're saying. And the reason why you need to personally guarantee, first of all, you know, you should show that you believe in your business, right? Again, it minimizes our risk too as well if you're personally guaranteeing. If you're not willing to personally guarantee, what you're saying is, I'm not willing to actually, what you're saying to the lender is, I'm not willing to risk my name, put my name on the line, or put my finances on. And if you're not willing to do that, why should the lender do the loan and take risk, right? Just keep that in mind. So that's a big thing. I would say most of the time, you know, for for-profit companies, I can just say that you're gonna have personally guaranteed. It's very rare that businesses can stand on their own, if you will, without having a personally guarantee. $1 billion businesses, $1 million businesses, but most of the time you're gonna have to personally guarantee. What is the SBA, and does the SBA make loans? The SBA is a Small Business Administration. Does the SBA make loans? The SBA typically does not make loans. They typically back loans, and they typically back it for the lender, right? They'll typically back the lender anywhere up to 75 to 85% of the guaranteed loan amount. I won't get into calculation on that, but just know they typically back it for the lender. Now, in disaster situations, they do make loans, like during the pandemic, like Hurricane Harvey, those examples, right? Those economic and disaster loans. Probably remember some of those. Some of you may have some too as well, but that's what the SBA does, and they typically do not make loans. So this is kind of the end of our presentation. So I just want to say in summation, be prepared to provide all documentation requested. You'll typically have an initial checklist actually from your lender when you're applying for a loan. Just keep a lookout, and I'm sure they'll be communicating with you as far as additional checklists they'll be asking for, you know, depending on the structure of your deal, the strength of your deal, the weakness of your deal. Be prepared to answer any questions about your loan request, including the tough questions. How did the pandemic specifically affect you? You know, how did the Texas snowstorm affect you? I'll give those examples, those kind of things. And make sure you utilize your local resources to build your plan, such as score.org and sba.gov. These are just examples. The SCORE provides free mentorship. You do not have to pay for any of their mentorship. They will help you throughout your whole business life. And you can have multiple mentors too as well. SBA.gov, not sure if any of you guys have gone there, but a lot of good information on their website. It's a lot of information on their website, but a lot of good information that's on there. Always use a competent accountant that specializes in business taxes. You may have been using the same accounting for 20 years, but they don't understand business taxes, or you've outgrown them. You need to get that tax advisor or tax consultant on your team that understands business taxes, because they can make or break your business. And this is where I'll say you have to have your team of people. You got to have that lender, that banker, right? You got to have that insurance person. At some point in time, you may have to have an attorney, because a lot of people are too happy now. And then you have to have that you know, that mentor and that business tax advisor, right? A tax consultant, and make sure they're all actually meeting your needs to try to reach your goals and aspirations of what you're trying to do. Remember, this is your business. You decide who you want to use. So now I'd like to take this time to thank everybody for being patient with me with all the technology and everything. And, you know, thank you for allowing me to be able to share all this information with you. I hope you have found value in this. And now I want to open it up for questions that you may have. Thank you.
Thank you so much, Tim, for that information. Absolutely great information. And we had several people say, thank you for the information. Does lending or qualifications differ for nonprofits? Like, how do you guys support nonprofits?
Yeah, it's different. It's a little different. It's kind of a loaded question. I mean, we're still looking at the financials, because typically you're not going to have, you know, tax returns and stuff like that. So we'll look at financial statements for them. We want audited financial statements. So, because we do loans I've done loans for churches, matter of fact. So we're going to want audited financial statements, though, audited profit and loss statements and balance sheets. we're still going to ask for this. They should have entity documents, right? Like if you're a 501c3, you should have certificate of formation too as well with the Secretary of State of Texas. So a lot of the documentation is very similar. I can say with personal guaranteeing, that's where that kind of varies on nonprofit organizations requesting loans. We don't always necessarily need to have somebody personally guarantee if the nonprofit organization can stand on its own from a capacity standpoint, but it always strengthens the deal if somebody's willing to personally guarantee. I'll give an example. Like if it's a church and the pastor's willing to personally guarantee, or maybe you have some people on the deacon board that are willing to personally guarantee, that shows they believe, right? And so they believe in their church. They believe that, hey, we're strong, we're going to be able to pay you back, or no worries or anything like that. So it's always, the lender's always going to want that personal guarantee, because again, it minimizes the risk, right, to the lending institution.
And what about for franchisees? Specifically, they don't have their personal history of doing business. So what does that look like for them if they're looking for loans for real estate needs, or even to franchise?
Yeah, now if you're, I don't know exactly, you can correct me if I'm wrong, if I'm not answering your question, what you're really trying to ask. I don't know if you're asking like, is it a person that's looking to open up a franchise, or they're actually with a friend, or they're actually trying to, how can I say, buy into a franchise, if you will. So let's say if they're a franchise and they're starting up, typically we're gonna want to see that franchise agreement, which they're gonna want to see that, of course, too, as well. But I would say before you purchase anything, you purchase for purchasing anything with the franchise to get into the franchise agreement, go to the lender, because typically, since it's going to be a startup business, you're probably going to have to look at an SBA loan, right? And if they need to be on the SBA approved vendor list in order to be able to get an SBA loan. So you might want to check that when you're trying to look at purchasing into a franchise. If the reason why that's important, because a lot of lenders, how can I say, a lot of banks, if you're a startup business, again, it's high risk. And if there's no SBA approved, they're probably not going to be able to do it. They're not going to do it on a conventional basis, right? So if you're not on the SBA approved, if they're not on the SBA approved vendor list, then they're not going to be able to do it on an SBA loan either, because you're not on the SBA approved vendor list. So therefore, they're not going to be able to actually, work with you and trying to entertain that deal. Some of the CDFI alternative lenders, maybe they'll look at it. But a lot of times they want you to be on the SBA approved vendor list either, because they don't want to do it on a conventional basis, because they want to have that backing, that protection. If you go out of business, remember what I said is that the SBA will back the lender anywhere from 75 to 85% of the guaranteed loan amount. So if you're having to put down, 15, 20% or whatever, they have a little bit of collateral, you go out of business, they're covered, right? So I would say get with the lender, talk the franchise agree. If it's a franchise, especially if it's an SBA approved franchise, in that franchise agreement should show the structure of everything that you are kind of looking for. It may be a general. So like, let's say if it's a franchise that started in Georgia and they're just now coming to Texas, they may not necessarily know all the costs here, right? And so that person's going to have to do their homework. This is where that mentor has to come in, like maybe from SCORE or SBDC. Or I'm not sure if you guys provide any mentors, but that mentor is going to have to come in and be able to help. Hey, what are you looking for? What are the costs? And their business plan needs to be specific to where they're actually going to be opening their business at, like the location, the area, and all that stuff. I know that was a loaded answer, but we're still going to need the same documentation for a franchise. Whether you're a franchise, existing business, non-franchise, right? If you're not an SBA approved franchise, not even a franchise at all, we're still going to ask for the same. Does that make sense?
Yeah. Can you tell those in attendance a little bit about you all small business program that you all have?
Is that what you're talking about? Yeah, so we have our masterclass program. We actually cover, I've got 7 of them I'm doing this year, quite a bit. It's a blessing. It's a blessing actually be able to do, but I cover Texas and Oklahoma. So we have not started the one in Dallas or in Fort Worth yet. The one in Dallas will be starting in July. and I believe we'll be having it at the state fair is where the location is going to be.
Okay.
There'll be more to that, but with that masterclass, we typically will go take the business owners through a 6-week program. So we'll teach them anywhere from how to actually develop your business growth plan to understanding what are financial statements, because I know not every business owner even understands what financial statements are. What are profit and loss statements? What is a balance sheet? And the terminology that goes along with it. What's an asset? What's a liability? What's your net worth? Why are they important? Right? We have a tax consultant, CPA, that comes in and speaks on that and teaches a class. And then I'll teach the class on the basis of business lending, which I'll get a little bit of. I'll also teach the class on how to fill out an application completely and accurately and a personal financial statement, because that is a big deal. And then we also teach the small business owners how to pitch a lender. So there's a pitch contest at the very end. And so, that pitch contest, we typically give them 2 minutes and 15 seconds to be able to pitch a lender, because you literally probably have seconds really to pitch a lender. So if you guys have seen Shark Tank, very similar to that. We have 3 judges, 2 as well. And usually it's somebody from our executive team that's kind of showing up as far as one of the judges. I know last year we had somebody from Texas Bankers Association too as well. So it's a big deal. It's a really, really big deal. But it's really good practice for the business owner, because a lot of times business owners will come to a lender and it's too early. They're not ready really to come to a lender, and the lender starts asking all these questions and they just don't look like they're prepared or they understand it, and it's not a good look. So that's why we do these classes. But yeah, we have one that's going to be going on in Dallas, and then one that's going to be going on in Fort Worth too as well. I would say probably in the next 3 to 4 months, we'll be starting Dallas, and then the end of the year we'll be starting Fort Worth.
Okay, great. Well, we didn't have any other questions in the Q&A chat. Thank you all. Thank you for all who attended. As I put in the chat, you all will receive a survey about the topic around basic business lending. We also have another session this month around finances. It will be around business tax. So I hope you guys had opportunity to register for that. If you have not, you can visit gptx.com/smallbiz. And you will receive a copy of this presentation, right, Mr. Coates? You will provide me with that, and then I can provide it to the attendees. You have any questions? You have Mr. Coates' information on the screen. He's a very busy man, but I'm sure he will take your call and answer your questions, and I will be glad to do the same. So thank you all, and with no further ado, we will end this session. Thank you, Mr. Coates.
Thank you. Thank you all so much.
Have a good one.